Okay, so thanks very much for inviting me. When Somdatta invited me, I tried to protest accurately that I'm a dilettante in these matters. I've only done a little bit of work on this area, but she insisted that I speak in specifically about real issues in economics or real issues that we're facing. So what I thought I might do is probably address one of the big questions that's there in economics at the moment, which is on the efficacy of monetary policy. The reason to talk about it in this kind of context is, as we know, the economy is a complex system, and in economics we often have the problem of taking too much aggregation and trying to establish relationships at a high level of aggregation. It's worked in many situations, but in some situations, as we're increasingly realizing, the structure, the microstructure of the economy matters enormously. So I've put in quotes the interest rate, and interest rates is the topic of today. We often speak in economics about the interest rate as if there's only one interest rate, but we're really interested in multiple interest rates and the way that they move. So this, so very often in economics textbooks, you have this diagram that looks something like this. This is apparently how monetary policy is supposed to work. You have something like a policy interest rate, it's the repo rate in India or the federal funds rate, and that's supposed to sort of seamlessly affect variables such as inflation or output through many mechanisms. The one that most often we speak about is through market interest rates. So the idea is that you move the repo rate, somehow market interest rates move, somehow aggregate demand moves as a result of that. By the way, I know I'm going to be using some economics jargon, so if people want to interrupt and ask about anything, please feel free. And that has an effect on inflation. And so we have this sort of, I would say, false precision very often, saying that we have a particular target, and somehow we move this one thing, this policy interest rate, and that affects the overall economy. Notice, however, that in practice, this is actually very hard to achieve. In fact, people like Janet Yellen, who was the former Federal Reserve chairwoman, others have called this a sort of minor miracle that this works at all, right? And the reason is that once you've moved past a controlled economy, we're talking about an economy with millions of decentralized balance sheets, trying to affect an outcome like inflation requires you to affect every step of the monetary transmission mechanism. Right? It's in India and in other countries where you actually had administered interest rates for many years, it was easy to actually have an effect on the final interest rate. But in fact, once you've had a deregulated financial system and a system which is more market-oriented, it is much more difficult to actually have the policy rate affect final rates. Policymakers themselves currently are unsure about which mechanisms are working. There was a recent paper by Viral Acharya, the outgoing deputy chairman of the Reserve Bank, saying that we don't know which particular mechanism is working at any given time. So, in some sense, you're kind of hoping that there's going to be an effect. You don't know which one of those arrows are actually working, and it seems extremely clear that credit policy is unstable. Yeah. So it is an exogenous variable in this case. The interest rate that we're talking about here is the policy interest rate, and that's set. It is set in one particular market. Now, the other rates, the market interest rates, and so on, are endogenous to the system, as we'll see.
Yeah, but even at my
yeah,
you have to have some kind of formula to fix.
I'm not sure I understand the question. So,
why are you supposed to change interest rate? That means there must be some driving force.
Okay, so the idea of trying to change the policy rate is to have effects on the final output, the final variable that you're interested in, inflation. So the RBI and most economies around the world follow some sort of inflation targeting rule, and the belief is that changing the policy rate.
This is not very exogenous.
Sorry?
This is not exogenous.
So I'm not sure what you mean by exogenous. It can be set in a market, but it's aiming at something else. So it's reacting to a particular set of real world issues. But it's not in the sense determined within the system. It's determined by
Use literature rule versus discussion.
Correct.
because that whether you're treating interest rate exogenous or not. Like literature is talking about that.
So no, I'm not sure that's correct. But let me just go on. So the basic question right now is whether, in some sense, credit policy, the way that we actually undertake credit policy, is stable or unstable, right? And post the global financial crisis, there's been a big question about whether credit policy is efficacious at all. So originally, for the last 20 years, there was a belief that somehow monetary policy should be the way that you manage the economy, and that fiscal policy should be left to the side or should be meant to manage debt. But post the global financial crisis, when you've actually seen that moving the policy rate actually has not much of an effect on the final rates, there's been a rethinking, and a theoretical rethinking as the result as well. Let's go through how the monetary transmission mechanism is supposed to work, right? We sort of believe, because of this picture earlier, from the policy rate to inflation, that there's some sort of easy way in which you can actually affect inflation. So if you ask a first year or even a third year undergraduate how inflation is managed, they say the money supply changes, whatever that means. The interest rate changes, again, what that means, it's not very clear. And somehow that's supposed to affect inflation, right? But typically there are many steps to the process. How would it actually work? I'm using the federal funds because most of the data that I'm going to be using is from some paper I've done in the US, using US data. Here is the repo rate. Right? The idea is that if you change the repo rate, the rate at which banks or financial intermediaries can borrow the highest form of money, which is reserves, that changes. So the cost of funding changes. The cost of funding that changes for the short-term interest rate, which is the policy rate or the repo rate, is supposed to affect the cost of funding for the whole portfolio that banks hold. That in turn is supposed to affect the long-term risk-free rate, which is the long-term treasury rate. And from the long-term treasury rate, you're supposed to have effects on the rates that we're concerned about, mortgage rates or car loan rates or kind of economically relevant rates. So you see this, and that of course is supposed to affect real activity. So there's actually at least 5 or 6 steps, all of which involve decentralized coordination in money markets and in financial markets in general. And over time, we've seen that, in fact, what used to be a tight relationship between the policy rate and longer rates has fallen away, right? So the key idea that I'd like to get at is that that there's actually a complex structure of interest rates. There's no point in speaking about the interest rate as we do. And it's not, any given rate is not simply the policy rate plus some credit premium, which is how we often sort of treat it in monetary economics. And the current explanations that we have, and I'm talking about even the cutting edge explanations of what determines the spread between the policy rate and the final rates is lacking, very seriously lacking. The belief right now, or at least I wouldn't say the belief, the theory right now has it that it's basically credit premium plus expectations of what's going to happen over time to the interest rate, which has an effect on the final rate. This, we've seen over and over again, evidence for this is lacking. Turns out that there's a very strong element of convention in setting longer rates. If market participants believe that the interest rate is going to be higher in the future, it will be higher in the future. Now, this is a very interesting and problematic issue for economics, because the question then becomes, how do these conventions get set in markets? And how do you change those conventions if you're going to actually affect monetary policy? There is an alternative way of actually analyzing what's happening in markets, and that is really from a Keynesian perspective, what's often called the liquidity preference account of interest rates. And that argument is actually slightly different from the conventional argument. That argument talks about the shiftability of bank portfolios between more liquid assets and less liquid assets, and that the interest rate is actually a reward for giving up liquidity. And that was Keynes's great insight. Right? And the idea is that all of these things, more and more people are coming to this understanding that liquidity preference is really behind a lot, and it can't be analytically separated. So what I'm going to be doing in this talk is really discussing the history of the monetary transmission mechanism, and this is using data from the US from the 1950s that we have. This is a paper that several papers actually I've done with J.W. Mason, and this is really from the Journal of Post-Keynesian Economics, just to give you a sense of how the transmission mechanism has broken apart and what are the explanations for that. All right. So, as I was saying, the dislocation, the structure of interest rates. We can ask a question, has an increase or decrease in the repo rate, or in the US, the equivalent, which is the federal funds rate, reliably led to changes in market rates? That's what we are hoping for, right? And that's what, in fact, all the hullabaloo of, watching, for example, the financial markets watch the day in which the interest rate is changed, or there's discussion about what's going to happen to the interest rate and so on. The idea is that has an effect on the final rates. What's the evidence? The evidence is actually quite slim. Early on, I'm talking about 20, 25 years ago, Alan Greenspan actually noted that the effect on final rates from changing the policy rate was actually becoming less and less. He called it, he's losing control of the steering wheel of the economy. That was the way he put it. And there's a lot of people who've studied this in the years that have followed. Specifically, Hassan Jomer and Daniel Thornton have actually found that there has been the impact or the relationship between the short rate and the long rate has started to fall away in the past. So here's a picture, which I think is a kind of dramatic picture about what's happened to interest rates. This is from 1955 to this 2010, but it hasn't changed too much. This is the effective federal funds rate annual from the Federal Reserve database. And you can see that there's actually been about 4%. Under Reagan and Volcker, there was a huge increase. It went up to 16% in the 80s. And ever since then, there's been a decrease. And after the global financial crisis, the aim was to actually lower interest rates to boost demand. It's been at zero. Right? So the question is, all right, so we've seen the interest rate that we're interested in, the federal funds rate actually declined. What has happened to economically relevant rates? Did it carry over? The answer is actually no. Real rates are higher in the 90s and 2000s and often the 50s and much of the 60s and 70s, even though the short rate is very low, and there's much higher spreads between the Fed funds rates and long rates after 1980, right? So here's, I think, it's a very colorful picture, but it should be very clear what's going on. The black line is the federal funds rate, right? In real terms. Okay, so controlling for inflation. And you can see that the black is actually very closely linked with all the other rates in this period, say from 1950 to 1980. The green, I'm sorry, I don't know what the green is, I should be there, but the blue is the 10-year Treasury bond, the red is the BAA corporate bond, and the yellow is the 30-year mortgage. So they're all typically above the federal funds rate, as you'd expect. They're longer-term mortgages, they're longer-term interest rates, but they're kind of tightly clustered here. Ever since the 80s, when you had a much more deregulated system, you've actually seen something interesting, which is that the federal funds rate is declining on this path, but all the other rates, although they're linked and they seem to also be declining, seem to be much less correlated. There seems to be a dispersion, and they don't follow closely anymore. All right. You can see this with respect to several subsectors as well. This is for households, and this is the nominal rates for mortgage debt and household debt in general. What's interesting is this: once you control for inflation, you'll see that actually real rates in a period where actually, if you look behind here, sorry, you can see that interest rates were about 4-5%. And that roughly translated into real rates of the same amount. But real rates were higher and have been higher even in periods of declining nominal rates in the short end of the market. Right? And this is even more dramatic if you take a look at non-financial corporations. All the way between the 50s and the 80s, the effective interest rate for non-financial corporations was lower than this period after the 80s. Okay, that's understandable in the 80s because there were high short-term rates, but even at the lowest rates, once the Fed funds rate, remember, is around 0 here, corporations are still paying high rates. Right? So this is the question, why has this broken down and how to explain this? Here's another look at the same kind of figure, right? So this is the 10-year Treasury and BA bond rate less the federal funds rate. And you can see that actually they are quite close together in the period between 1955 and about 1980. After 1980, something dramatic happens. After 1980, private interest rates are much higher and persistently higher than the federal funds rate. It's always above 0 and much larger, right? Okay. So there are two puzzles that we need to ask. Why have the long risky rates been higher compared with the short rate, which is the policy rate? And more importantly, why have they responded less to the policy rate? Because if it's a large difference, but it responds, at least you can say that there's a response. But that hasn't happened. And in order to do that, we need to understand the factors which create wedges and dampeners in this mechanism. And that's the sort of understanding that we want to get. Right, so moving backwards, there are two explanations that are given. One is what's called the credit spread. And that's the argument that if you take the treasury bill or the bond at any particular rate, the credit spread is the amount the amount that the interest rate is charged that's above that, because it's a risky rate versus the riskless rate of the government bond, right? So that could be one of the causes, that the credit spread is rising. The second cause could be what's called the term spread. That is, we often see this particular pattern that longer term bonds, if you put your money away for a longer time, you charge a higher interest rate. So this term spread might be another thing that is causing the increase in the spread between the policy rate and the final rate.
Two are not related to another spread that we use, is the difference between lending rate and borrowing rate.
That's the funding spread now. It's linked in the monetary transmission mechanism because of the fact that we are actually interested in this. It's the cost of funding, right? But once you're past that, these are different spreads that you're interested in. So the funding spread is also important, but we're really interested in these two spreads. And a lot of financial economics is really trying to understand why you have these two spreads, right? All right. So this might be a cause, right? We might be thinking that one of the reasons that you have an increase in the spreads is that credit spreads have increased after 1980. That could be one of the hypotheses. Well, it turns out that so you can actually analyze this by looking at this: the AAA corporate yield versus the 10-year bond rate, right? So this is a measure of the credit spread. Between 1950 and 1980, again, a much more controlled and regulated financial system, the difference was not much. There was a consistent spread of about 0.5%. Right? After the 1980s, it's gotten much wilder, about 1.2% on average, which is the difference between, so that would be the credit spread. Now this large increase of about 0.8, so about 80 percentage points in the yield cannot be explained by a credit spread. Why is that? Because this risk premium that you should have should be reflecting some sort of default risk, right? And default on AAA corporate yields is very, very low. As it turns out, if you actually look through the math of this, the default loss is actually half of the default rate. And what we saw was, in fact, the annual default rate rose from 0 to 0.05%. So very, very little increase. Is the question? No. It was very, very little increase in the spread. In the default rate, right? But that either one assumes that something changed drastically and bondholders became much more risk averse, or we must say that there's actually no reason to believe that this is actually reflecting a credit spread, because in fact default risk did not rise. Right? In fact, even if you take if this was the case, there is no change in the AAA and BAA premium. If you saw that, then you could say, okay, maybe some credit risk is actually coming into the system. In fact, there is very little evidence that credit risk has actually increased in the system, yet the spread has increased. It's a big mystery about what's going on here, right? Furthermore, empirically, a lot of people have done studies. Defaults don't explain credit spreads, right? So these are quotes you can take a look at. It's not terribly interesting, but it's paper after paper after paper which has tried to actually analyze credit risk spreads and said, we cannot actually understand or analyze this as arising out of default risk, right? So actually, this is worthwhile looking at. Huang and Huang says credit risk accounts for only a small fraction, typically 20% of the observed corporate treasury yield spread. So 80% has to be explained by something else. What could that be? All right, this is where the Keynesian example comes into, comes into its own. And this was talked about by Keynes many, many years ago, where he said that the interest rate is not a rate that you actually charge for credit risk. It's actually a liquidity premium. Okay, the mainstream theory assumes that the price of the asset is equal to its expected income, but Keynes, and following him, Hyman Minsky, a very famous financial economist, argued that the most important ability that very often financial firms require, is the ability to translate an asset into money. That's liquidity, right? And that's the key distinction among assets. The reason why treasury bonds actually trade lower is not that they're less risky, but that they're much more liquid. And that's a separate sort of argument that we want to actually address. Increasingly, it's recognized as an issue in mainstream economics. Jean Tirole, who won the Nobel Prize a couple of years ago, Bengt Holmstrom and others have tried to actually come up with the theorization of this. It's much more difficult than the simple credit risk argument, and it doesn't fit with the dominant methodology. So this is a set of areas in which people are trying to actually look at the shiftability of assets and trying to understand how this works. All right. So, fair enough, one can say, okay, it might be liquidity, the liquidity premium which is causing this increase in the spread, but then why would this premium rise after 1980? And the argument here is that that in fact what has happened is that you've had a much more deregulated system, and there are more stories of the world in which default is possible. It doesn't even require default to actually occur. Once you have the stories of default being possible, people much prefer to keep much more liquid assets than illiquid assets. Not only that, there have been actually changes in the financial system. So earlier you used to have a very stable base of deposit funding. Households used to put their money in deposits, and you could sort of reliably rely on that as a liquid source of your assets. But it turns out that since then, households have had many more financial assets that they can put their money into. For example, money market funds. And so once you moved away from a stable base of deposit funding, it becomes exceedingly hard for any financial firm to have liquid assets, and as a result, they load up quite extensively on the most liquid asset, in this case, treasuries. Not only that, one of the interesting things which has happened in the macroeconomics, especially of the US, but across the world, is a movement to austerity, and governments don't spend. The moment governments stop spending and stop borrowing, they release less and less of the highest quality asset in the financial system, which is government bonds. Once you lose this extremely high liquidity asset, you start moving to actually a situation where you're more and more worried about your liquidity situation, and therefore you charge a higher premium for anything which is not a liquid asset. So this is another set of arguments, which is, by the way, a non-mainstream way of looking at it, which is to argue that the liquidity premium has risen since 1980, and that really is the fundamental cause of this rise. And we're seeing it as a credit spread that we can't understand. The reason we can't understand it is it's in fact a liquidity spread. Okay? Again, so this has now entered a lot of financial economics. Ziegler and Darrell Duffy have written about it, Perrodin and Taylor, others. the basic idea here again is that the moment you actually start to look much more closely at the microstructure and start to look closely at liquidity within a particular market, you start to see that in fact this can actually explain a lot of this rising spread. All right. Here's the other thing, a term spread. So we said that going forward from the monetary transmission mechanism, one thing that could explain the rise in the spreads was the credit spread. The other could be a term spread, which is to say that you see a rise in the spread because people are holding longer term assets. Now, once again, you will see that this is the. Let me just make sure I'm saying the correct thing. Yeah, so take a look at this particular number. This is the 10-year rate minus the 10-year forward rate, which is to say this is a measure of the extent to which you have a premium placed on any particular asset because you're holding it for a longer period. But between 1953 and 2011, that was at about 1.4%. 1953 to 1981, you can actually say that it was roughly around zero. You weren't holding assets for a long time because of your belief that you weren't seeing an increase in the interest rate because you were holding it for a very long period. Between 1981 and 2011, in fact, that actually changes dramatically. You can actually see that you now require 3.3% premium to actually hold an asset for 10 years in a fixed bond rather than holding it the forward rate for 10 years, right? So this change is actually a measure of the increasing importance of the fact that it's not simply expectations and it's not simply interest rate risk. The expectation hypothesis, which is actually what often drives these changes, before 1980, missed this, but it was missing it high. Now you can actually see that there's a very large premium to holding assets for a long period of time, right? The expectations hypothesis, which is the mainstream way of looking at this, suggests the following. This suggests that the long rate is simply the mean of the expected future short rates. Now, it's very interesting because there's a lovely statement that was made by someone who's summarizing this, and he said, if there is any theory which would win a prize for the number of times it's been rejected by evidence, it would be the expectations hypothesis, and it's almost always rejected, right? And so people have tried different theories to try to resolve this and solve this, and they have come up with a modified form, which is, I think, really a cheating form, where the solution is basically whenever there's a discrepancy, I'll add a time-varying premium, which comes out of nowhere, and therefore you can resolve this. But in fact, the expectations hypothesis that people respond very quickly to the long run responds very quickly turns out to actually be quite false. And there's now increasing evidence in financial economics and increasing number of papers that are being done, which argues that the expectation formation that we have in standard theory is quite wrong, right? This very famous paper by Monica Piazzezzi and Schneider, they actually look at investor expectations and they find the following. It is simply not true that people take a look at interest rates now and change their expectations of interest rates in the future. Because that's what you would actually need for the policy rate to work, right? That you see a lower interest rate now, I say, okay, interest rates in the future are going to change and therefore change. It simply is not the case. There's very inelastic interest rate expectations. Why is that? That turns out to be a very important question. Moreover, they actually don't forecast turning points in interest rates very well. Market participants are very bad at forecasting. And they're counter-cyclical. That is, they often depend on the present and not on the future, right? Guidolin and Thornton found something quite interesting. There's a general inability to predict even the close short-run interest rates. So, taken as a whole, what is this suggesting? This is suggesting that our model that somehow we can understand long rates as the average of short rates or expected short rates is simply wrong. That in fact there's a very strong element of convention in current interest rates. And that is the argument is, should be quite straightforward. It's the following, it's that if I don't expect interest rates to go up in the future, or rather if I believe that interest rates are going to be at a particular level, once interest rates come down, I need a very sharp decline in interest rates for me to actually change the market convention that interest rates are going to be longer and higher in the future, right? So there's a new set of theories to explain these anomalies. These are things that are being brought up in economics right now. Rational inattention models, which suggest that in fact, instead of taking very long-term views, people take short-term views and hold on to convention. Bayesian updating, adaptive expectations. All of these may be constrictive of actual expectation formation. Right? The alternative to this is what I would call a post-Keynesian view. And that actually is much more radical view, and that's the argument that as Keynes himself would put it, the future is generally unknowable, that expectations are very durable because they're based on conventions. All of us agree that without a kind of conspiratorial way, but once you have an agreement that there's roughly the interest rate is going to be around 2%, that's very durable, and the current situation becomes a very important primary guide to the future. As a result, you have highly inelastic expectations and they're anchored in the present. The result of that is that any policy rate, it'll take a long time to translate into any changes in conventions. You have to hold policy rates low for a very long time before people start believing that future rates are going to be low as well, right? So what are the implications for theory? And I'm coming to the end of my talk a little early, but if we're correct, and neither credit risk nor expectations hypothesis can explain spreads, there are two important arenas for scholars of complexity. And the first one is, how do the balance sheets of intermediaries interact to create conditions for lower or higher liquidity premia? So this is something we don't understand. I sort of gave a kind of a very broad brush argument that conventions are durable, but how does one understand that from the microstructure? How does one understand that from the interlocking balance sheets of each of the financial firms that we're talking about? What's the actual process of expectation formation? If the expectation hypothesis fails, how do you explain the role of convention and how convention is shifted? At what point does having short policy rates for a long time actually change the convention and people start believing it and therefore pulling down the long rate? That's a very difficult question which scholars of complexity have to understand. I like this quote from Keynes. It's a long quote, but I think it gives the flavor of what I'm trying to get at. Knowing that our own individual judgment is worthless, we endeavor to fall back on the judgment of the rest of the world, which is perhaps better informed. That is, we endeavor to conform with the behavior of the majority or the average. The psychology of a society of individuals, each of whom is endeavoring to copy the others, leads to what we may strictly term a conventional judgment. Now, a practical theory of the future based on these three principles has certain marked characteristics. In particular, being based on so flimsy a foundation, it is subject to sudden and violent changes. The practice of calmness and immobility, of certainty and security suddenly breaks down. New fears and hopes will, without warning, take charge of human conduct. The forces of disillusion may suddenly impose a new conventional basis of valuation. What he's saying is quite, I think, what we might actually think about is having a phase change. How is it that we suddenly start with a situation in which everyone is looking at everyone else's judgments, we therefore arrive at a convention, and then we're trying to shock the system through this policy rate. At some point or the other, that becomes a convention and the policy rate actually works. It is not simply a mechanical way in which short-term rates, the average of short-term rates is seen in the future as a long-term rate. In fact, there's some sort of deeper structure that we need to understand. What is the implications for policy? And this is my last slide. Credit markets are segmented or partitioned. Anywhere along the monetary transmission mechanism, you might have some firms which are constrained, some which are not. And to be effective, it has to actually target that particular constraint anywhere along the monetary transmission mechanism. The other thing that's extremely important is the importance of conventions. If the low rate is if the long rate is low, there's a reason for that. If it's high, there's a reason for that, and that reason is actually conventions. That even despite current short policy rates being short, you might expect the long rate to actually continue to be high as long as conventions are not changed. And so there may be multiple equilibria, and the standard supply and demand framework is very misleading here. Here's another very important thing. Monetary policy affects the direction of credit and the distribution of income. This is coming back to Anirban's question of distribution. So the choices of what we want to finance are unavoidable. And more importantly, when we're talking about these interlocking balance sheets, how this distribution will come about will depend on the particular structure, the microstructure at that point. Two other very important points. Given that these violent changes based on conventions, and the asset misplacing in 2007, we should raise doubts about how a deregulated financial system is actually allocating capital very well. There's a strong case for credit policy here, right? And this is separate from what we've seen here. And finally, raising rates across the board may do little to reduce asset market speculation because there's an element of convention in all of these things, but it might have major effects on whichever parts of the economy are interest sensitive or credit constrained, for example, agriculture, small, medium enterprises, home building. So this is actually by way of kind of rounding out what seems to be the current challenge for monetary policy, which is to think through how the policy rate actually affects various parts of the monetary transmission mechanism and the complex kind of interaction of these balance sheets and conventions in those effects. Okay, I'll stop with that. Thank you.